If you're trying to decide whether to buy in 2026, you're probably hearing two stories at once. One says the market's dead and nothing makes sense. The other says prices will only go up and you're blowing your chances if you wait. Neither of those help you make a real decision. I'm Luba Beléy, a Toronto real estate broker working in Toronto's West End and South Etobicoke. Since 2008, I've worked with buyers and sellers through hot cycles, cold cycles, and odd years like this one. In this video, I want to show you how this 2026 market actually works and how to connect it to your own numbers and your own life. By the end, I want you to know which group you're in. People who should be looking seriously at buying in 2026, people who clearly shouldn't force it yet, or people who could have bought in 2022 and need an honest look at whether it still makes sense now. My main goal here is to give you a clear way to decide whether buying in 2026 genuinely fits your life and your numbers. So let's start with what actually happened in 2025. When you hear that the GTA market is slow or stalled, it can sound like nothing is happening. So let's look at what actually happened in 2025. When you see numbers from the Toronto Regional Real Estate Board, TRREB, you're looking at a much bigger region than just Toronto proper. TRREB covers the city of Toronto, the 905 around it, Peel, York, Durham, Halton, and nearby communities like Dufferin and Simcoe. For 2025, TRREB reported roughly about 62,000 home sales through its MLS system, around 11% fewer than in 2024. Nearly 187,000 new listings, roughly 10% more than the year before. An annual average selling price of about $1,068,000, and that's about 4.7% lower than in 2024. That's what a slow year looks like. More than 62,000 properties still changed hands. Every one of those sales had a buyer and a seller. That's over 124,000 households deciding to move in the so-called stalled market. At the same time, it has been a hard landscape for first-time buyers for years. Prices are high, qualifying is strict, a lot of people feel locked out. And in the same region, you also have parents helping kids with down payments, families pooling resources, people with strong incomes, bonuses, or inherited equity. So you end up with two realities at once. For some people, buying feels out of reach. Meanwhile, properties are still being bought and sold every single day. The work here is not to stare at the averages. The work is to figure out which side of this you're actually on and what is realistic for you before you make any big decisions about 2026. Let's talk about what the big players are actually calling for, the 2026 forecasts and CMHC's projections out to 2030 and beyond for prices, rents, and housing supply. Along with TRREB and CMHC, I also look at the national forecast Royal LePage Real Estate Services Limited brokerage, my brokerage, puts out. Their reports are public and used by banks, media, and analysts across the country. In plain language, their latest outlook says this. Across Canada, typical home prices in Q4 2026 are expected to be about 1% higher than in Q4 2025. In the GTA, prices are expected to be about 4.5% lower over the same period. Two things I want you to remember about forecasts. First, these are big regional averages. They blend condos, towns, semis, and detached homes across dozens of different micro-markets and price points. Some pockets will hold value better. Some condo buildings or streets will soften more. This does not tell you what will happen to one specific home you are looking at. Second, a forecast is just that, a forecast. It's an educated view based on the data we have today, not a guarantee about your address or your timeline. So how do I use this in real estate? For me, it sets expectations. It tells me we are likely in a slower negotiated 2026 market where prices can still move around a bit while the market finds its new balance this year. And I'm done with the real estate is dead story. For the last few years, the chorus has sounded like this: real estate is dead, it will never come back, no one's buying anything. Good, it shouldn't come back to what it was. The COVID spike, dirt cheap money, blind bidding, offers in an hour, that was a fever. Everyone got high on cheap debt and fear of missing out and called that the market. What we have now is closer to a healthy market. Normal listing times, conditions on offers, buyers who have time to think, prices that are actually negotiated. Is it as exciting as 15 offers on a Tuesday night? No. Is it more sane and sustainable? Absolutely. We could spend hours talking about wars, trade deals, AI, oil prices, and recession odds. None of that is trivial, but none of it decides for you whether this is the right time for you to move. Real estate doesn't live in a bubble, but it also doesn't pause until the world comes down. People still get born, families expand, people separate, jobs change, people relocate and retire. They still need somewhere to live. So instead of staring at every forecast and every Bank of Canada headline, the better questions are these. What's actually happening in my life? How long can I realistically stay put if I buy? Does this home and this mortgage make sense for me? Not for a headline. The forecasts are background. They tell you roughly what kind of market you're walking into. The real work here is connecting that to your actual life. To understand whether buying in 2026 makes sense, you have to see the bigger backdrop this reset is sitting inside. Canada's housing problem is not a feeling, it's math. CMHC has been modeling what it would take to get back to something like 2019 level affordability. Their latest work says this: to restore affordability by 2035, we would need to almost double the pace of building to around 430 to 480,000 new homes per year. And if we don't, Canada faces a housing supply gap of about 2.6 million homes by 2035. Most of that shortfall is in Ontario and BC, with smaller but still important gaps in Quebec and Alberta. At the same time, Ottawa's plan still brings in roughly 380,000 new permanent residents per year between 2026 and 2028. Temporary resident programs are being tightened to reduce numbers, and even then, we are still talking about several 100,000 people a year. And while we need more homes, a lot of builders are doing the opposite of ramping up. With today's rising construction costs, financing costs, and pricing, some projects simply don't make sense on paper. That means delays, pauses, or cancellations instead of the surge in new housing CMHC is calling for. Put that together and the picture is pretty clear. We still need hundreds of thousands of new homes over the next decade. We are still adding hundreds of thousands of people every year. We are not building at the pace the Federal Housing Agency says we need. If we don't build enough and we keep adding people, the extra inventory you see in this 2026 reset does not sit on a shelf forever. It gets absorbed by end users buying homes to live in, by investors repositioning their portfolios, by renters competing for a limited number of units. Some CMHC scenarios, summarized by independent analysts, show one path where if we keep building at the current pace, the average home price in Toronto could be around $1.95 million by 2035. That's roughly a 60% jump from 2024. In that same scenario, average rents across Canada rise by about 40% in 10 years. You are not required to believe that exact path. But it is one serious evidence-based view of what happens if we keep underbuilding while the population keeps growing. That's why I don't treat this softer 2026 market as a permanent new normal. It's a phase inside a long-term shortage. So instead of asking, will real estate ever go up again? The better question is, how do I want to live through the next 5 to 10 years of this story, as a renter, as an owner, or by staying exactly where I am? Most people obsess over the interest rate. I care more about how big a mortgage you're actually signing up for in 2026. A lot of brains are still anchored to two moments: the pandemic, where a 5-year rate started with a 1 or a 2, or the period where 5 to 6% 5-year rates were showing up in people's actual approvals and renewals. We are in neither of those places now. As I'm recording this in early 2026, most first-time buyers I see qualifying for insured 5-year rates at around plus minus 4%, depending on the file and the lender. Most forecasts expect 2026 to stay roughly in this range, so I treat this level as the range we plan around. What matters is not just the rate. What matters is the rate plus the purchase price and what that turns into every month. Let me show you an example using real years. Scenario A, peak frenzy early 2022. This is the type of purchase I was seeing a lot in the height of the market. Purchase price, $1 million. Down payment, 20%, $200,000. Mortgage, $800,000. Interest rate, 2%, 5-year fixed. Amortization, 25 years. The rough principal and interest payment on that mortgage is about $3,400 a month. That's before tax and insurance. Scenario B, 2026 reset. In many pockets, prices from that 2022 peak have come down in 15 to 25% range. So let's use a simple 20% drop for comparison. Purchase price, $800,000. Down payment, 20%, $160,000. Mortgage, $640,000. Interest rate, 4%, 5 years fixed. Amortization, 25 years. The rough principal and interest payment on that mortgage is also about $3,400 a month. So in both cases, you are paying roughly the same amount every month. But in the 2026 scenario, the purchase price is $200,000 lower. Your starting mortgage is $160,000 smaller, $800,000 versus $640,000. You've kept $40,000 in your pocket instead of putting it into down payment on a more expensive home. Your land transfer tax and closing costs are lower because they're based on a smaller purchase price. You can absolutely choose to put more down if you have it and push the payment even lower. The point is that a higher rate on a smaller loan can land you in the same monthly ballpark as a low rate on an inflated purchase price. But over the long term, those two decisions are not the same. Borrowing $640,000 is a completely different commitment than borrowing $800,000, no matter what the headline is. Most buyers still obsess over the interest rate. Is 4% good or bad? I care much more about one thing. How much am I actually borrowing, and does that amount make sense for my income and my life? You've probably seen headlines that most mortgages, or 70% of mortgages, are renewing around 2025, 2026, and it can sound like everyone is about to hit the wall. If you're part of that wave, the real question is, what does it actually mean for you and your payment? Let's break it down. A big chunk of those renewals are people who bought before or around the 2021-2022 peak, locked in very cheap 5-year rate, have been paying down their principal faster over those 5 years because so much of each payment went to principal, not interest. Some of those owners also purchased well before 2021 and are now on their second, third, or even fourth 5-year term, with mortgage balances much lower than when they started. So yes, many mortgages are renewing into higher rates than before, but that does not automatically mean people are in crisis or that the market is going to hell. At renewal, a few things are in play. Your rate is likely higher than your old one. Your mortgage balance is lower than when you started. You've already chipped away at the meaningful chunk of your principal. In real life, that shows up like this. Some households see a noticeable jump and need a plan. Some see a smaller change that they feared, and some see very little change or even a slight drop in the monthly payments. Some owners also use renewal as a chance to refinance and take some equity out to cover other goals and obligations. That's a separate decision and a good reason to sit down with a mortgage professional and see exactly where you stand. The impact is decided by your specific mortgage, your income, and your options at renewal, not by a national headline. Now, what to do if your renewal is coming up? If your mortgage is renewing this year or in the next 6 to 12 months, don't wait for the renewal letter. Take an hour now to see where you stand. Your nervous system will thank you later. Talk to your current lender and a mortgage broker. Get a rough payment estimate at today's rate. Ask about your options for term and amortization. Clarify the process requirements and paperwork, whether you renew with the same lender or refinance with a new one. Remember, banks and lenders compete with each other, so ask for a discretionary rate, as posted rates are meant for marketing. You don't have to accept the first number you see in a letter. Once you know the steps and the payment range, renewal becomes something you can plan and prepare for. How renewal connects to, is it a good time to buy? This renewal wave matters because people renewing are already homeowners. Some of them are quietly asking, if I'm touching my mortgage anyway, is this the moment to also change the home attached to it? For some, the answer is yes. The new payment is manageable, they've built decent equity, and the move actually solves a real problem: space, finances, school, commute, health, family. And for others, the honest answer is no. This renewal is about stabilizing what they have, not upgrading yet. Both are legitimate positions. Looking at renewal this way shifts the questions from, will 60 to 70% of mortgage crash the market, to, what does my renewal look like and how does that fit into my 3 to 10 year plan? That's the lens that belongs in a 2026 buy or wait decision. Your timing, your payment, your tolerance for risk, not a headline written for the entire country. If you're stuck on whether to keep renting or buy in 2026, let's put the numbers side by side for a minute. If your rent is low and owning would push you too far, you already know the answer. You keep renting and build savings. If your rent is high, you owe it to yourself to see how it compares to owning in 2026. First, write down your current monthly rent. Then get one realistic ownership number for something similar. Add up mortgage payment at today's rate, property tax, condo fees, if it's a condo, a basic amount for maintenance. That total is your monthly cost to own. If that number is far above your rent, buying right now may not be worth the pressure. If it's in a similar range or a bit higher, but still comfortable for your income, then you have an actual decision to look at. That's when it makes sense to get advice from a mortgage broker and from someone like myself with your realistic numbers on a table to see if buying in 2026 makes sense for you or not yet. And remember, rent is also a valid choice. The point is to base that choice on clear numbers, not on fear of the market or guilt about still renting. If you already own a home, the real question isn't, is it a good time to buy? It's, does it make sense for me to sell and buy in this market in the same time? Your math is very different from a first-time buyer's. The number that matters is the gap between what you sell for and what you buy for, not the sticker price on either property, the gap. In a softer market like 2026, you may sell your current home for less than you could have in the peak, but you're also buying your next home for less than you would have paid in that same peak. If both moves happen in the same conditions, you're trading inside one pricing environment. You're not selling low now and then buying high later. This matters most if your mortgage is up for renewal soon, your current home no longer fits, or you want to reduce your monthly costs by downsizing. In that case, you might move into something smaller and easier to carry. Shift into a different type of home or neighborhood that fits your next 5 to 10 years plan better. If the gap between the two is workable, the move can be right decision. The questions to sit with are, if I sell now and buy now, what is the actual dollar gap between the two? Does that gap make sense for the next chapter of my life? Does the new home put me in a better position financially and practically over the next 5 to 10 years? If those answers are yes, then for you, 2026 can be a good time to move, regardless of the noise in the headlines. Is it a good time to buy? Also depends on what you're buying. The averages hide in a big split. How this market is treating condos versus how it's treating freeholds. In the last couple of years, condo apartments in the GTA have generally taken more of a price hit than freeholds. More listings, more price cuts, and more room to negotiate. Freehold homes, detached semis, and many freehold townhomes have held their value a bit better. For buyers, that can mean two different stories. If you're looking at the condo, in some buildings, there is more room to negotiate on price. However, you have to pay close attention to building health, the status certificate and reserve fund, the percentage of investor-owned units, whether big repairs have been done, and which big repairs will need to be funded soon. You also need to be honest about your monthly condo fees and how they fit your budget now and over time. If you're looking at the freehold, you're not paying condo fees every month, but you're fully responsible for maintenance, repairs, and any surprises, roofs, furnaces, plumbing, exterior work, all of it. So your monthly cash flow looks different, but so does your overall responsibility. Neither path is automatically better. Each segment has its own small market inside the averages and its own risks. The GTA average will never tell you what's really happening to a specific 2-bedroom condo downtown or a 3-bedroom detached home in Bloor West Village. If you're serious about buying, you want to zoom into property type, price range, and specific pocket or neighborhood. That's where the real story and real opportunities reside. How long you can stay put in the property changes almost everything about whether buying in 2026 makes sense for you. Buying in 2026 can make sense if you can see yourself staying in the property for at least 5 to 10 years, your income is reasonably stable, you have a proper down payment, closing costs, and a buffer. You're not draining every account just to get the keys. You could ride out a normal market cycle without needing to sell. And the home actually fits your life. Commute, kids, parents, schools, daily routine. Waiting is probably smarter if you're likely to move again in under 3 years, your job status or family situation is in flux, your numbers only work at the lowest teaser rate and fall apart if the rate is 1% higher. A simple filter is this: does this home fit my life, and can I carry it through a normal up and down market without needing to sell? If that's a clear yes, buying in 2026 is worth a serious look. And if it's not, it's better to pause and keep building your base. Here is the lens I'm looking through when I talk about buying or selling in this market. I'm not watching this market from the sidelines. I'm an owner and a landlord. I've gone through rate swings, renewals, refinances, and tenant turnover. In other words, I'm living in this market financially the same way my clients are. Professionally, I've spent more than 17 years working with buyers and sellers in Toronto and the West End through hot markets, cold markets, and strange in-between markets like this one. I also spent a lot of time talking with other professionals whose work touches real estate every day: mortgage brokers and lenders, accountants and financial planners, real estate lawyers and brokerage leadership who see what's actually happening in the numbers. What you are hearing in this video is a synthesis of my own portfolio, my clients' real files and experiences, and current data from TRREB, CMHC, LePage, and major lenders. You're not listening to someone just reading headlines. You're hearing from someone who owns property here, carries mortgages here, sits in rooms with the people who build and finance housing in this region, and has skin in the game when these decisions play out. So, is it a good time to buy in 2026? The real question isn't what the market is doing. It's whether 2026 is the right year for you to buy. Here's the honest answer. For some people, yes. If you have a solid 5 to 10 year time horizon, have stable income and a real buffer, not just enough to close, can handle a normal market cycle without needing to sell, and you found a home that genuinely fits your life, then buying in 2026 can make sense as a solid long-term decision. For others, the honest answer is not yet. There are households where even after a pre-approval, the numbers don't support a safe purchase at today's prices and rules. In that situation, it's more realistic to keep renting for now. Focus on building your savings and income and wait until the math supports ownership without putting your whole life under stress. And then there is a third group, people who could have bought in 2022 and still have the income and savings to buy today. For them, 2026 can actually be a stronger position. Prices are lower, the monthly payment can land in a similar range, and they're borrowing a smaller amount over the long term. The real question for that group is this: do the numbers make sense for me now, and does this home fit the next chapter of my life? Doing nothing is still a decision. The key is that it's conscious and based on real numbers, not fear, regret about 2022, or fear of missing out. This is general information, not personal advice. Any real move you make should be grounded in a full conversation with your mortgage professional, your accountant or tax professional, and your real estate lawyer reviewing what you're signing. You're the decision maker. The market won't sit still. The point of everything you've just heard is to give you enough clarity to decide whether a move now truly serves your life and your numbers. If you're in the planning mode, you can start by downloading my complete buyer's guide. The link is below. It walks you through the process from the first should we buy conversation to keys in your hand. If you're facing a real decision and wondering if it's time to buy, that's what my clarity call is for. We'll look at your numbers, your timing, and your options. You'll leave with one clear next step that actually fits your life. If you found this helpful, please like, comment, and share. Yes, I do read and reply to your comments, and subscribe so we can grow this channel together. Thank you for watching.